Good morning. I'm going to talk through some of the early results of some economic modelling work that we've been doing as part of the Southwest Marine Energy Park. Some of the sort of interesting bits that have dropped out of that so far. It is ongoing. It's based on working with industry. We've got some good contacts through the Bristol Tidal Energy Forum. We've also run a similar sort of piece of work with Marine Energy Matters, Colin Cornish, and Wave Hub looking at Wave, and I'm going to sort of focus a little bit on Tide this morning. So in terms of sort of the approach that we've taken, we're looking at a top-down, bottom-up approach. So taking the investors' expectations, mapping that onto a price sort of target for our project, our technology developers, and then looking at how the supply chain delivers against that price. Is it possible? Is there a disparity? Why we're doing it? Strong progress to date in the UK. We're in a very good position. We've got a very attractive strike price. So the market looks good, but we have a limited time frame in which to become competitive. And in order to make the best use of that time frame, we need to understand the sort of commercialization pathway which takes us from where we are now to a competitive point. It also enables us to have a good understanding of sort of cost reduction potential and identifying where we reduce cost in the makeup of those projects. So what makes a project investable? Given the strike price that we have and the 15-year CFD period, we've modelled these sort of three arrays. So this is working through from sort of where we are now and where we'll be in the next couple of years, so 10 megawatts arrays, through to a sort of commercial state, so at 30 megawatts and beyond. And as Colin mentioned, we've got this sort of proving ground around 10 megawatts, 20 megawatts, which are really sort of critical first-tier projects, where in order to deliver against those, we call this the sort of developer's dilemma. The commercial project has to come, but in order to get there, you need to go through these sort of earlier steps, which give you a much lower return on your investment, but enable you to sort of prove your reliability, to develop your warranties, which are all important in then getting that sort of later stage financing. I've written 6% internal rate of return up there, which I'm guessing will probably make Charles squirm. I'm not suggesting that 6% is a commercial rate, but more that if you sort of bring together your grant funding, a bit of finance, you provide a return for some of the parties involved through the development of IP and sort of market positioning, then you can get to a project that works at around about 6%. And that's probably a point of discussion later. And so that takes you through from where we are to where we need to be. The question is, can we deliver against those price targets? The good news, and I was expecting, as I said at the start, to see some sort of disparity between this top-down, bottom approach. And the good news is that it doesn't seem to be a great disparity. So at the current stage that we're at, the supply chain is able to deliver against that £5.5 million per megawatt capex figure that I stated for a 10 megawatt farm. So how do we go about soaking up that 6% internal rate of return? And that's essentially the sort of the bite the bullet part of this. You know, who's going to absorb that risk and that cost? Because it's not going to come from the finance sector, it's going to have to come from within the industry. I've highlighted four potential sources here. Utilities, we have seen some good engagement from utilities to date, but in reality they're not in the business of developing technology, and so we shouldn't look to the utilities, I don't believe, in the long term to provide that sort of that soaking up a risk. Technology developers, certainly we've seen the OEMs come through and provide that ability to have a sort of long view of the market and to soak up the risk, to position themselves and develop IP. That's how they're making a return at present. The supply chain, certainly, the benefit of the supply chain is that they often bring experience from other sectors which can make the innovation required to deliver parts of the supply chain very effective, rather than the technology developers doing that themselves. But in order to engage the supply chain properly and to keep them on board in the long term, which is very important, I think, to deliver the industry, we need to make sure that risk is appropriately apportioned, so we don't pile all of it onto our supply chain and make unrealistic demands that mean they can't operate commercially in the long term. We've seen companies like KML and Mojo with their device developments provide a real sort of key injection of IP and innovation into the sector. So it really is an important way of developing part of that return. And government certainly through grant funding. And grant funding makes quite a big impact on that internal rate of return that we talked about at the beginning. It's something like £3 million for a percent increase in your internal rate of return on a 10 megawatt project. So a couple of points on cost reduction potential. We often, and this is, I guess, about managing investor expectations, we often talk about the distribution of cost in a project on a sort of very average basis. So we take 25% is associated with installation, etc. It doesn't, if you build up from the bottom with a few different technologies, and I've deliberately left out the names there to avoid getting in trouble, but you get quite a different picture, quite a different spread across each of those technologies. And that's partly because at the minute we're dealing with very sort of vertically integrated organizations. So the technology development companies tend to retain IP in all areas of their business, which is understandable. We're in a sort of a risky stage, and it's important to keep hold of that. But as the industry matures, I think we'll see that dissipate. And organizations like the ETI, like TSB, like the Catapult have a key role to play in sort of spreading that and picking up those sort of cross-sector issues. So the interesting point about that is that whilst the distribution changes, it would appear that the overall cost remains relatively similar. It's a sort of push it in one place and it pokes out another sort of problem. Secondly, we always deal with these very sort of smooth cost reduction profiles based on learning rates, which is true, and it's a good way of modelling where we need to get to, but it I think probably betrays the reality, which is if we're going to keep our investors on board, we need to ensure that they're aware that that curve might not be smooth. There are going to be plateaus where the progress is very little, and then there's going to be sort of disruptive technology changes that mean we can make a sort of step change. So if we're going to keep our investors on board, they need to have a sort of, we need to give them that view up front. And lastly, because in keeping with regional stereotypes, the Southwest is awash with cake and afternoon tea. This is what aggressive cost reduction looks like. I'm an engineer, so I have a tendency to go for the fresh raspberries and organic egg solution, right? But in reality, what we're going to need to do is, if we're going to take this sector forward, is to get to a point where we're powdered egg, we're raspberry flavoured filling, whatever that is, marshmallow, all sorts of hideous things. But what it does is give us a product in a market where price is the ultimate metric of what we're doing, the cost of energy. It gives us a product that's attractive to investors. So that one on the left is attractive to investors, the one on the right is attractive to my granny, who isn't an investor. So there's a sort of overview of the sector for you. Thank you very much.